Income. Income is the starting point of all personal finance because it is the money that flows into your life. It usually comes from a job, a business, or investments, and it sets the limit for everything else you can do financially. Historically, most people relied only on wages, but over time, multiple income streams became more common as economies grew more complex. What makes income important is not just how much you earn, but how stable and predictable it is. A steady income allows planning, while an unstable one forces constant adjustment. Understanding your income clearly helps you make realistic decisions about spending, saving, and investing. Expenses. Expenses are the money that flows out of your life to pay for goods and services. They include everything from basic needs like food and rent to lifestyle choices like entertainment and travel. The concept is simple, but the challenge lies in control. Expenses tend to grow quietly over time, especially as income increases, a pattern often called lifestyle inflation. What makes expenses important is that they directly shape your financial health. Even a high income cannot build wealth if expenses rise just as quickly. Understanding your income clearly helps you make realistic decisions about spending. Budgeting. Budgeting is the process of planning how your income will be used over a specific period. It gives structure to your finances by assigning purpose to every unit of money. While budgeting has existed in simple forms for centuries, modern tools and apps have made it easier to track in real time. What makes budgeting different is that it turns passive spending into intentional decision-making. It matters because it prevents overspending, reduces stress, and ensures important goals like saving and investing are not ignored. Saving. Saving is the act of setting aside money for future use instead of spending it immediately. It often begins with small amounts, but builds over time through consistency. In earlier generations, saving was often done physically, like storing cash or gold, but today it mostly happens through banks and digital accounts. What makes saving unique is its focus on safety rather than growth. It matters because it provides financial security, especially for emergencies or short-term goals, and acts as the first step toward financial independence. Emergency fund. Emergency fund is a specific type of saving meant to cover unexpected situations like medical expenses, job loss, or urgent repairs. It is usually kept in easily accessible accounts so that the money can be used quickly when needed. The idea gained popularity as financial planning became more structured, emphasizing preparedness over reaction. What makes an emergency fund different is its purpose. It is not for growth or regular spending, but for protection. It matters because it prevents people from falling into debt during difficult times. Banking. Banking refers to the system of institutions that help you store, transfer, and manage money. Banks provide services like savings accounts, current accounts, loans, and digital payments. Over time, banking evolved from physical branches to online platforms, making financial access faster and more convenient. What makes banking essential is its role as the backbone of modern finance. It matters because it keeps money secure, enables transactions, and connects individuals to broader financial opportunities. Interest. Interest is the cost of borrowing money or the reward for saving it. When you deposit money in a bank, you earn interest, and when you take a loan, you pay it. The concept dates back thousands of years, forming a core part of financial systems across civilizations. What makes interest important is its dual nature. It can either work for you or against you. It matters because it influences how money grows over time and determines the real cost of loans. Debt. Debt is money that you borrow with the promise to repay it later, usually with interest. It comes in many forms, including credit cards, personal loans, and home loans. While debt has been part of human societies for centuries, modern credit systems have made it more accessible than ever. What makes debt complex is that it can be both useful and harmful. It matters because responsible debt can help achieve goals like education or home ownership, while excessive debt can lead to financial stress and long-term instability. Credit score. Credit score is a numerical representation of your creditworthiness based on your borrowing and repayment history. Lenders use it to decide whether to approve loans and what interest rate to offer. The system developed as financial institutions needed a standardized way to assess risk. What makes a credit score important is that it quietly influences many financial opportunities. It matters because a higher score can save money through lower interest rates, while a poor score can limit access to credit. Investing. Investing is the act of putting money into assets with the expectation that it will grow over time. This can include stocks, bonds, real estate, or other financial instruments. Unlike saving, which focuses on safety, investing involves some level of risk in exchange for potential returns. What makes investing different is its long-term perspective and its role in wealth creation. It matters because it allows money to grow faster than inflation, helping individuals build financial security over time. Stocks. Stocks represent ownership in a company, giving investors a share of its profits and growth. When you buy a stock, you become a partial owner of that business. The stock market has evolved over centuries into a major platform for raising capital and creating wealth. What makes stocks unique is their potential for high returns, along with higher risk. They offer one of the most effective ways to grow wealth over the long term, especially when approached with patience and discipline. Bonds. Bonds are loans that investors give to governments or companies in exchange for regular interest payments and the return of the principal amount later. They are often seen as more stable than stocks, though they usually offer lower returns. The bond market has long been a key part of global finance, supporting infrastructure and development. What makes bonds different is their focus on predictable income. They matter because they provide balance in an investment portfolio and reduce overall risk. Mutual funds. Mutual funds pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. They're managed by professionals, making them accessible even to beginners. The concept gained popularity as people looked for simpler ways to invest without deep market knowledge. What makes mutual funds appealing is diversification and professional management. They matter because they reduce risk compared to investing in a single asset and make investing more approachable. Insurance. Insurance is a financial tool that protects against unexpected losses by transferring risk to an insurance company. In exchange for a premium, the company agrees to cover specific types of damage or loss. The idea of insurance dates back to early trade systems where merchants shared risks. What makes insurance essential is its focus on protection rather than profit. It matters because it shields individuals and families from financial shocks that could otherwise be devastating. Taxes. Taxes are mandatory payments made to the government to fund public services like infrastructure, education, and healthcare. They come in different forms, including income tax, sales tax, and property tax. The system has evolved with societies, becoming more structured and regulated over time. What makes taxes significant is that they directly affect your net income. They matter because understanding taxes helps you plan better, avoid penalties, and make informed decisions. Inflation. Inflation is the gradual increase in prices over time, which reduces the purchasing power of money. It means that the same amount of money buys fewer goods and services in the future. Inflation has been a constant part of economic systems, influenced by factors like demand, supply, and monetary policy. What makes inflation critical is its silent impact. It matters because it affects savings, investments, and everyday expenses, making it essential to consider for the future.